Hey everyone, thank you guys for tuning in to the Witty Wallet, a money podcast to help you make sense of finances and make smart financial decisions in today's uncertain world. Every week, I will explore the nuances of personal finance, economic news, and financial decisions that affect everyday people like you. I'm your host, Kristoffer Fu, Chief Executive Officer and Financial Advisor at Maven Bridge Capital. So again, thank you guys for taking your time to listen to the Witty Wallet. As most of you may already know, I formerly had a different podcast called Succession. And you might be wondering, well, what happened with Succession? You know, we love the content that you were delivering, and why the change? So last year, just kind of doing some reflection, last year was a, a, a lot had happened last year, from a business standpoint, but just also just from the world in general, right? I mean, if we look at 2022, it started off literally like a slap in the face with inflation. Inflation came out raging, right? Gas prices hit almost $7, I think, here in California, and we just weren't expecting a lot of that to happen, and we had to make adjustments really fast. We had to reassess how these changes were going to affect us. And naturally, when it comes to the stock market, when investors start to see the market take some dives, right? It's because of the behaviors. It's we naturally want to gravitate towards safety because we feel in our mind that if these losses continue to persist, well, at the end of the day, we're not going to have any more money. That's the thought process. So what do? We naturally want to just sell. We want to sit on the sidelines, just lick our wounds, take the remaining cash that we have, right, and just wait for the good news to all of a sudden reappear. And then that's when we'll get back into the market. Unfortunately, studies have shown that doesn't work, right? Because oftentimes while you're waiting for the good news to happen, the market's already on its way back up. So in situations like we saw last year, the first thing to do is take awareness of the situation and start to take notice and see how does that affect my current situation. So as a financial advisor, I had to do a lot of that with my clients and reassess what are these changes that we're currently going through, and how does this affect us in the next 12 months? How does this affect our long-term goals and our midterm goals? And more importantly, what important strategic changes can we be making to our investments, to our plans, so that we continue to move forward in the right direction as opposed to stopping and not moving forward, right? So it's about making strategic adjustments. And that's exactly what I did with my podcast. I love doing the podcast, and I had an amazing time interviewing a lot of individuals that I deeply admire. And I just wanted to pivot. I wanted to make some adjustments to make sure that I continue to pay it forward and give you guys actionable advice and tips that you can take. And with that, right, anything that I talk about on this podcast is not meant to be financial advice. This is all for educational purposes, because I believe that the more we educate ourselves, the more we can feel secure in any type of decision that we have to make, whether that be personal decisions, financial decisions, or business related decisions. So here we are. So, I've been reading a lot of articles lately, and stuck out, talked about the debt ceiling, right? And this is a reoccurring theme, a reoccurring issue that constantly Congress has to address, and that's raising the debt ceiling. And for those of you that don't know what the debt ceiling is, think of it as kind of like the US's credit limit, right? If they were to have a fat credit card, and every time they need to raise a debt ceiling, it's basically asking to raise their credit limit so that they can borrow more money and continue operations and obligations that are already outstanding. And if they don't raise the debt ceiling, it is gonna it's gonna cause some risks. It's gonna cause a lot of uncertainties because that means that we can no longer um, pay bills, right? We need to pay bills. We need to pay people that we owe. So that's not a great thing. And so there's a lot of talks as far as when the government might run out of money, the implications of not raising the debt ceiling. So it's something to be aware of. And so why am I bringing this up? Um, another important thing that had happened at the end of last year was the passing of what we call the Secure Act 2.0. And the Secure Act 2.0 is essentially a plethora of provisions that affect a lot of retirement planning. So in my world, that is a big focus with a lot of my clients is retirement strategies and retirement planning. And there was a lot of provisions that had passed. So scanning through those provisions, I definitely found some key themes, I want to say, and some important ones that I wanted to highlight. So I'm going to start actually by sharing a story. So a couple of years ago, I had met this potential client. She was a prospect at the moment, and she came to me. She was about 72 at the time, and she came to me with her investment statements because she was just concerned with her portfolio and what was going on in the markets at the time, and wanted a second opinion. So she sought me out, sat down, started a conversation, and I was just reviewing her statements, and I noticed a couple things. So I asked her, this was towards the end of the year. I had asked her, when are you going to take out your required minimum distribution? And she paused. She looked at me. She was like, I have no idea what you're talking about. What is a required minimum distribution? And so to kind of provide some context, this was when you were required to take out minimum distributions at 70 and a half during that time. So I told her, your required minimum distribution, you had to start it when you were 70 and a half. And basically what it is, it's a minimum amount of money that you have to take out of all of your pre-tax accounts. So if you have 401ks, traditional IRAs, traditional SEP IRAs, the aggregate amount, whatever that is combined, starting at your required date, you have to take a distribution out each and every year going forward until you die. And that amount changes, it increases each and every year. So she looked at me panicked, and I can see, she was like, I had no idea. I didn't know what I was supposed to do. No one told me. And unfortunately, that's a situation that I've come across a couple times in my career so far. And so I let her know, hey, the penalty, unfortunately, for not taking out the distribution at the time was 50%, 50. So her distribution that she had to take out, I calculated it was around 20,000. So her penalty would have been 50% of that, or $10,000. And that's not to mention the income tax that she's still gonna be liable for on that minimum distribution. And again, the reason why you're supposed to take out this money is because this money has never been taxed. So to put into context, right? All your money that you have in these pre-tax accounts, they've been sheltered. They have not been touched by the IRS. So that's why they're requiring you to take out a certain amount and pay income taxes on it. It's how they can continue to collect revenues. So when I told her the penalty, she started to panic, right? I can tell she was super, super stressed out. And I tried to calm her down. I said, look, unfortunately, this is a common situation. What I advise, what I recommend is definitely getting together with your accountant, your CPA, and let them know what had happened, that you miss your required minimum distribution. And then also contact this particular firm, the firm on the statement, and let them know, hey, I missed my distribution. What can you do to help me? Because there was nothing that I can do for her on my end, right? Because she's a prospect at that point. So that was the advice that I'd given her. And a few weeks had passed, and I did a follow up call to her, and she she was like, "Hey, Chris, I'm so happy that you called. That meeting that we had several weeks ago. I spoke with my accountant, like you said, and we were able to draft a letter and sent that off to the IRS. And the IRS came back and said that it's okay. We understand. We're gonna let it go this one time." And I was shocked. I was like, "Really?" Other times I've seen it where there was a reduction in the penalty, because they tried to correct it within a certain time frame, whatnot. But her particular instance, she got really lucky, as far as avoiding that 50% penalty. But she did the right thing, right? You have to take out that distribution. Because again, you get audited, they're going to come back and slap you with that 50%. So the reason why I bring this story up is because it does relate to 2.0, the Secure Act 2.0 that had just passed. And one of the provisions was that your required minimum distribution date is now increased. So in 2019, when 1.0 had passed of the Secure Act, they had changed the date from 70 and a half to 72 is when you were supposed to start taking out your distribution. Now that date is 73 is when you need to start. So for those of you that turn 72 this year, happy birthday. You get an extra gift. You don't have to take out a distribution this year. You get to wait until you turn 73 next year. But again, this is a important requirement to take note of because it's a common theme that a lot of people don't realize that it's their responsibility, that they need to make sure they take this required distribution out each and every year, whether you need the money or not. Now, one of the other provisions to tie onto that is the fact of the penalty. So again, if you remember, she was almost going to be hit with a 50% tax penalty. And with this new provision, what had happened was that they reduced that penalty down from 50% to 25%. Cut it in half, essentially, which is good news. But still, again, guys, it's a penalty. And what they also said that is if you correct it within a timely manner, then that penalty goes down from 25 to 10%. So, moral of the story, at the end of the day, yeah, the penalties are reduced, but unless you love paying penalties, make sure that when your required date happens, that you put it on the calendar. If you have a financial advisor, make sure that they're on top of it to help ensure that you're getting it taken care of. Contact your CPA. Just don't miss it, right? Because no one loves to pay a penalty. I certainly don't. And that's free money that you're essentially just giving away to the IRS. So again, the other thing about this Secure Act 2.0 that I have noticed is there's this Rothification theme that is going on with a lot of these provisions, and what I mean by that is Roth IRAs. Or I'm a big fan of Roth IRAs because I like this idea of not having to pay taxes to the IRS in the future when I want to enjoy my money. Granted, obviously, I am paying the taxes today, but in the future, I have the ability to have tax-free income. So why not? Right? But again, everyone's situation is different. So what I mean by this Rothification theme and what is going on is, for one, for my business owners out there. Most business owners, we have the common problem of needing to self-fund our own retirement. And most small business owners, we will use vehicles such as a traditional SEP IRA or a traditional simple IRA. It gives us the ability to contribute money for our business, for our employees, and get a tax deduction. However, because our incomes are usually high, we don't have the ability to contribute to traditional Roth IRAs. Well, with the new provision, they actually established that business owners can use a Roth SEP IRA or Roth Simple IRAs, right? Giving them the benefit of tax deferred growth, but more importantly, tax free income in retirement in the future when they start to draw that money out. Now, granted, the difference, of course, is that you're not going to get a upfront tax deduction like you would if you were making a traditional SEP contribution, because again, it's a Roth contribution. You pay the taxes upfront. But again, I like this because it gives my small business owners, it gives us the option of finding additional ways to save and being a little bit more strategic when it comes to future tax planning and how we're going to utilize that to our benefit. Now, another provision that I think is very important is going to be for the ketchup provision. And I'm not talking about the tomato ketchup, right, that you guys are thinking about, but catch up. And what that provision is when you turn the age of 50, and if you have a 401k plan, sponsored plan, for example, you max out, your contribution. But when you hit 50, you're able to put a little bit extra each and every year because, again, you're getting closer and closer to retirement. Well, that catch-up contribution has increased to $7,500 for 2023. And starting in 2025, if you're between the ages of 60 to 63, your catch-up contribution amount is $10,000, and it'll be adjusted every year for inflation. So it's a great, great thing because, again, it allows us, as we're saving for our retirement, to save a little bit more each and every year because we're inching closer and closer to retirement. Now, some things to note for my high income earners. If your income is over $145,000 and you're at that age where you want to make a catch-up contribution, just note that those contributions will be made on a after-tax basis, right? So again, to put into context, before these changes went into place, right? If you were 50, you were able to make an additional $6,500 pre-tax contribution, right? It helped lower your income, especially if you're a high income earner. But moving forward, for those high income earners, if you're over a certain amount, it's not going to count as a pre-tax contribution anymore. It's going to count as a after-tax Roth contribution. So a couple caveats in addition to that. If your employer plan does not give you the option of doing Roth contributions, well, again, you're not going to be able to make those additional catch-up contributions if you're in that high income earner phase. So yeah, there's probably going to be some changes. I'm sure these employers, after they get a lot of employees maybe complaining that, I'm trying to save for retirement, but you don't have any Roth contributions. I'm sure the employer is going to make some changes. Who knows? But that's important to note. Again, if you're a high income earner and you're over the age of 50 and you're making those catch-up contributions, when you're making them, just remember that's not going to be a pre-tax contribution. It's going to be an after-tax contribution. Another thing that I like to note is with employer matches, right? Employer matches, if you work for a company that gives you an employee match, please, first of all, I hope you're taking advantage of it. That's free money from your company. But secondly, in the past, those employee matches or employer matches, used to be all pre-tax. But now you have the option of going to your 401k and saying, I want that to be a Roth matching contribution. So if your employer gives you a 5% match and you want that to go into the Roth portion of the 401k, you certainly can do that. Just note, it is going to be a taxable event. So you're going to pay income taxes on that. So again, there's always a catch, right? So you have to be aware of these particular nuances, these particular situations. So a lot of different things, again, that have happened in the Secure Act. And those are the things that I noticed that stuck out that I believe play an important role in the majority of the public, and that you guys need to understand, because it does gives us a lot more options, first and foremost. But when I take a look at it from a bigger point of view, right, giving us the ability to do Roth contributions as business owners, allows us to take our employer matches and have those be a Roth contributions instead. All of these situations, it does generate income tax today, right? Because again, if you're contributing to a SEP IRA, that's a Roth, you get no tax deduction as a business owner. If you decide to do a Roth contribution for your employer match, you got to pay income taxes on that today. And also, more importantly, if you are over the age of 50 and you're a high income earner and you're making your catch up contributions, again, those are going to be Roth after tax contributions. So you got to pay income tax on it. So again, if we look at this theme, right, I like to look at it and how does it tie into the bigger picture? It's the way of generating more income tax revenue because again, we have this debt ceiling, we have COVID that happened that had caused the government to print a lot of stimulus money, right? That ballooned the debt so much larger. And right now, I think we're sitting in still some of the lowest marginal tax brackets that we've seen in history. Right now, the highest marginal bracket is around 37%. But if we look at the charts in the 1950s, the highest marginal tax bracket was 94%. So that doesn't mean that all your money was taxed at 94%, right? That's not how our beautiful tax system works. Our tax system is progressive. And basically, the higher you earn money, every tranche is taxed at a different rate with the highest rate based off of your income. So in the 50s, right, if you were in the highest income bracket, your highest dollar was taxed at 94 cents on the dollar. So that's huge. Right now, we're sitting at 37%. What I'm trying to get at is, well, I'm a personal believer that I think income tax rates are going to continue to change in the upward direction as opposed to the downward direction. So I do see income taxes, at least in my eyes, again, just my opinion, not telling you guys one way or the other, but I do think we're probably going to see higher income tax brackets in the near and the long-term future. So what does that mean? Well, it could give us opportunities to, again, maybe take advantage of these low brackets and look at Roths, look at these Roth options that are now a lot more available to us, especially for business owners. Those are the couple bullet points that I wanted to talk about in today's podcast. And hopefully, again, you can take the bits of information and utilize that to your advantage. Because I know there's a lot of information out there for us to try and digest, but a lot of it is useless. And don't get me wrong, what I mean by that is there's a lot of information that is not applicable to your own personal life. So it's really hard to try and figure out, well, what is applicable and what is not. So with the Witty Wallet, my goal is, again, to try and find what is applicable to most people, hopefully you, and so that you can take that as an educational resource and use that to your advantage. Because I'm a firm believer that the more that you arm yourself with, as far as knowledge, the more security and the more freedom you're going to have in life. And so with that, I wanted to end on this note. We are January, still fresh, 2023 January. Everyone's fulfilling their New Year's resolutions at the gym, right? I try to go to the gym every day, or at least 6 days a week. I love working out. I love the mental clarity that I get from working out, the stress reduction that I get from working out, and more importantly, just the overall feeling I get. Right. And I love seeing new people at the gym trying to hit their goals and trying to lose their weight or just trying to continue to feel and get more healthy. I love it. It's a great, great thing to see. And so with that, I wanted to ask you guys, are you financially fit? Right? Are you financially fit to take on the goals that you want to accomplish this year? Are you financially fit to take on the unknowns that are going to be happening this year? Because again, if last year was any clue that unknowns happen. If you don't know, unknowns happen. Well, 2023 and beyond, there's always gonna be unknowns. So, are you financially fit? Are you financially aware of your circumstances? If not, I challenge you to take our assessment. So, over at mavenbridgecapital.com/FFC, I also have the link in the show notes. I'm offering a free financial health assessment. It's completely anonymous, takes 5 to 7 minutes. I'm just going to give you a snapshot of where you're at today. Right? It's going to be an eye opener, and if you don't like what you see, well, that gives you again some guidance, some action plans that you'll need to really think about, right? Because if you don't know where you're at today, how can you continue to plan and move forward? It's just like as if, again, for those of us that are at the gym trying to shed that weight, well, if we don't want to stand on the scale, how are you going to know what you're up against, right? How you know what type of diet plan that you need to do, or your personal trainer, right? They're going to ask you a bunch of questions so that they can take an assessment of where you're at today. That's exactly what a financial health assessment is, right? It's where you're at today financially. And if you don't like where you're sitting, well, what's the next steps at that point? So definitely take advantage of it. I challenge you guys, again, to see where are you at today and where do you want to go moving forward. Again, thank you guys for tuning in, and I will talk to you guys next week. Bye.
Securities offered through Kestra Investment Services, LLC, member FINRA, SIPC Investment Advisory Services offered through Kestra Private Wealth Services, LLC, an affiliate of Kestra is. Maven Bridge Capital and Kestra Investment Services are not affiliated. Kestra is and Kestras do not provide tax or legal advice. The opinions expressed in this commentary are those of the author and may not necessarily reflect those held by Kestra Investment Services, LLC or Kestra Advisory Services, LLC. This is for general information only and is not intended to provide specific investment advice or recommendations for any individual. It is suggested that you consult your financial professional, attorney, or tax advisor with regard to your individual situation. Comments concerning the past performance are not intended to be forward-looking and should not be viewed as an indication of future results.